Hi everyone, welcome to this session ICR and SCM Analytics workshop series. So today we are going to deep dive into de- demystifying intercompany reconciliation by Munmun, who is a technology leader in the field of data engineering and Gen AI quantitative intelligence methodology in Accenture. Over to you, Munmun.
Hi everyone. So, is there the echo is coming? Am I audible properly?
Yes, yes.
Okay. So, let me present my screen. Let me know if my screen is visible. Someone can clarify if the
Yes.
screen is visible.
Yes,
Okay. So,
yes,
yeah,
yes, yes, ma'am.
yeah. So, thank you. So, basically, this series we will try to cover. Like the first workshop, uh, probably we will understand what is intercompany reconciliation, the process as a whole. Because without understanding that, like doing any analysis or like how data engineering or data analytics can help in this sector, like it won't be like very much clear. So first let's understand that what is the process all about, and like why like we are studying these, and what is the like implication of like improper ICR. So all those things I will like deep dive into. So just let's start with the slide. So before going into the slides, a small introduction about myself. So currently I am having now 18 years of experience, and like led global projects worldwide, worked with the global giants, and kind of worked mostly in digital transformation as a part of Industry 4.0 and 5.0. My area of expertise is AI, ML, data engineering, data analytics, and of course, intelligent process automation. But apart from that, I have worked, like vividly in like website and mobile app development, kind of, like building the microservices, cloud technology, cloud configuration. So I am also, like involved with lot many colleges, one being Goa Institute of Management, where I am in the board of studies. Along with that, I am also pursuing my doctorate, and that is also kind of in related field in smart city innovations, basically. So without wasting much time on this, let's deep dive into this. So at the end of the session, I will be sharing you some links. So probably in the meeting chat. So probably those who wants to like take note of the links, they can take note of those links and contact later. So what is our key takeaways today? We will be studying intercompany reconciliation. What is related parties transaction? So this is a very important thing in Companies Act, and we will decode some scams, and like we will see some case studies, like read some case studies, and also like how to like what are the different ways to handle risks in ICR. And at the end, I can take some questions. Like if you guys have any questions, you can ask me. So excited? Okay, so let's start. Okay, so intercompany reconciliation by definition is it's a process of matching and verifying financial transactions between two or more entities within the same parent or company. So this is by definition in like in the finance, because it says that it is a any transaction which actually like we have to like match them, verify them between the two subsidiary companies, or say between two or more entities which is under the same group of companies or parent company. So let's say for take an example, like if a company has multiple subsidiaries, they often exchange goods, services, or money. So these transactions must balance each other before they get consolidated to the group account. So that is why ICR is very, very important. Now let's see some visual illustration of it, like what it means. Like I just given the definition, factual definition. So let's say there is a company, and it has some subsidiary company. So let's say a manufacturer who is having its like the manufacturing units, warehouses, then probably like the shipment company, like its own shipment company. So it has different like subsidiaries which is under the same group of companies. So let's say these companies are termed as company A, company B, and company C, and all these subsidiaries are under the same company, which is also called a parent company. Now, any transactions happening in between company A, company B, in company B, company C, or say company A, company C, or even subsidiaries with the parent. So any transaction happening between these entities, these are termed as intercompany transactions basically. And these should be balanced out in their own book of accounts before these transactions move into the consolidated statement of the group account. Okay, so let's take another example. It will be much clear. We will see like what are the different kinds of intercompany transactions which can happen. It can involve the exchange of goods, services, any financial resources between the two companies. Okay, so it can be sales and purchases when one subsidiary sells goods or services to another subsidiary. It can be like lending of money, like borrowing of the money. So it can be a loan lending between the two companies. That is also comes under intercompany reconciliation transactions. It can be the dividends which a subsidiary pays to the parent company or vice versa. And it can be the transfer of assets or liabilities between these entities. So these are the different types of intercompany transactions which can happen between the two different subsidiaries. Okay. Now let's take an example here to understand it more, like further. So if there are two subsidiaries, company A and company B, now, company A pays $10,000 to company B in return of receiving the office supplies. So, company B sells the office supplies, and for which company A pays company B 10,000. So, how it will be written in their own book? So, company A will write it as office supplies expense because it has spent for the office supplies, and it is $10,000. And the IC payable, like intercompany payable, is 10,000 CR. So, it is credited. Like payable is always credited here because it is intercompany payable, and office supplies expense because it is doing some expenses. So it is comes under like debit because it's a kind of an expense which is going out. Okay, company B will record this as receivable as 10,000 DR and revenue or sales because it has made some revenue from the sales, so that is credited. So that is CR. So now while doing this consolidation, both these transactions between company A and company B should match out. So basically we have to verify these two transactions, and okay, company A has done some dealings with company B and both these transactions are same. Okay, like we have like some ways to like verify those, like what are the invoice number, date and amount, whether they are matching or not. So depending on those variables, both these transactions will actually balance out, and whatever goes to the consolidated income statement, it doesn't reflect these two like these dealings basically between the two entities. Okay, so this is very, very important, and in the coming slides you guys will understand that why this is very, very important. This is called like settling of the intercompany reconciliation. It should balance out within their within their book of accounts before it moves to the group of accounts basically. So some of the terms and examples. So if we say that company A owes $100 to company B, so it is kind of payable is $100, receivables is $100. Intercompany loan, subsidiary X gives a loan 50K to subsidiary Y. That is also recorded as intercompany loan. Consolidation means combining this financial statement. I am using this word consolidation too many times. So consolidation means combining this financial statement to all entities into one. So ensuring all intercompany transactions are balanced and removed. So basically when we consolidate the financial statement to the group account, these intercompany transactions should be balanced and removed. And also another important factor is exchange rate. So if a company, like two companies are operating in different countries, then there should be a currency exchange rate in between them, and calculating that or keeping into account that exchange rate is very, very critical here. So these are some of the terms and examples. So let's understand now. Now this is very interesting and this is very important also, like when we talk about ICR, why related parties and interrelated parties are so important, because It is something, like mentioned in the Companies Act 2013. Okay. So any questions still here, like before I go to related parties?
No, not from my side.
Okay. So let's move on then. So a related parties transaction by definition is a deal, arrangement, or transaction made between two parties who have a pre-existing relationship. Example, family ties, shared ownership, or management control. Now, what does it mean? We will see, like, what does this mean? Like, who are the related parties? We will see that. Now, these parties are often referred to as related parties under the Companies Act 2013 in India, and their transactions must comply with the regulations to avoid unfair advantages or financial manipulation. So, specifically, what it means is there should not be any conflict of interest. So, these should be, like very much comply to the Companies Act, any related parties transaction. So, now, who are the related parties? So, basically, according to the section 2, clause number 76 of Companies Act 2013, related parties include directors of or their relatives. So basically, the directors of a company or any of their relatives. Key managerial personnel. So here, managerial personnel means doesn't mean manager. It is kind of MD of the company or the general manager of the company, like who is holding some key decision making factor. So key managerial personnel, KMPs or their relatives. Any firm, private company or public company in which a director or KMP or their relative is a partner, director, or holds significant control or interest. Okay. So any firm, private company or public company in which a director we know what is a director, any key managerial personnel or their relative is a partner, director, or holds significant shares, like control or interest means or holds significant shares. Any person on whose advice or direction a director or KMP acts. Okay. And the last one, subsidiary holding or associate companies. So all these factors, like if any one of these, justifies, then they are the related parties. So we talked about that who are the related parties. Okay, so it is either directors or KMPs or any of their relatives or somebody of their relative who is holding a significant control of share. Okay, and or any subsidiary holding associate companies or any person who is giving the advice or direction to the director or KMP. So these are all related parties. Now let's say an example. So we have two companies as we talked about. Let's say company ABC and company XYZ. Now we have Mr. Singh sitting as a MD of company ABC, but he is also holding some shares in company XYZ. Okay. Now his son, Mr. Singh Jr. say he is the KMP of key managerial personnel of company XYZ. Okay, so basically Mr. Singh Jr. is a son of Mr. Singh. So it is a relation, like he is a son, so he is in relation with Mr. Singh. Okay, and again, Mr. Singh is holding some shares in XYZ as well. Okay, now if company ABC actually, do some transaction with XYZ, okay, like take some goods or services from XYZ, then this will come to the related parties transaction. So as per the Companies Act, this is a related party transaction. So in this case, the Companies Act considers these a related party transaction and it must be conducted at an arm's length. So arm's length, I mentioned this term in different color. There's a reason behind it. I will explain this, what is arm's length. Arm's length price to ensure fairness and transparency. Okay, so now what is arm's length? Okay, so now lots of things happen over here, like in this, if it is not done in with fairness or transparency, it is sometimes leads to scam. So that those things we will see in the later slides. Okay, now let's understand what is arm's length. Okay, so while going to understand arm's length, let's understand transfer pricing. So while understanding transfer pricing, we will actually understand what is arm's length. Okay, so transfer pricing, as by definition, refers to the prices at which goods, services, or intellectual property are traded between divisions subsidiaries or related entities within a larger corporation, typically located in different countries. Okay, so we understand this like it is kind of transaction which is going between the two subsidiaries or companies or related entities within a larger corporation, like within a parent company, basically a group of companies typically located in different countries. So it is a cross-border transaction which is happening. Now, what is transfer pricing? Transfer pricing refers to the prices at which the goods or services are given. Okay. Now, these related parties often belong to the same parent company, but they conduct business with one another just as they would with an independent third party. Now, what does this mean? This means, say, company A is somehow related to company B, like as a definition of the related parties, what we have read, like who are the related parties. So let's say there is a, like the relation between company A and company B. Like by any of the definition whatsoever, it is existing there. Okay. Now, company A is in the US manufactures, in the US manufactures goods and sells them to its subsidiary company B in India. Okay. Now, the price charged for those goods is called the transfer price. Okay. So basically, whatever price they are charging for, like doing these dealings between these related parties transaction, like between these two companies who are related some way. So that price is actually called as transfer price. Okay. Now, why transfer price is so important? Why this pricing is so important? Because what happens is, now they don't, like when the related parties are dealing, they actually, like to avoid tax or, like to minimize tax, they basically shift the profit to the countries which are operating at the low tax rate. So basically, let's say India's tax rate is less than US. Okay. So they will sell, like they will strategize the price in such a way that the basically the profit shifts to India. Basically, the entire, like whatever they have, the price they would have, like given to any other independent party. Say company A is selling those goods to, like any other party which is not related to company A in anyhow, like any other party. Then whatever price they would have fixed, that is called arm's length. But if they strategize the price in such a way that actually they are shifting their profit, like they are showing in their book of accounts that we didn't have any profit, but actually they're shifting their profit to a country where the tax rate is low, then basically it is like the transfer pricing. That's why the transfer pricing is so important. Basically, they can strategize, like they can, decrease or increase their transfer pricing accordingly, like just to, like avoid the tax or minimize the tax. Now, this transfer pricing, why it is so important? Because governments actually regulates this. It actually, like sees that what is the transfer pricing being used and whether it reflects the arm's length. Arm's length means whether it is a fair price in which company A would have sold to any other independent party, not to the related party. Okay, so this is the meaning of the term arm's length. Okay, so here is the importance. So arm's length means the fair price or the justifiable price in which company A would have sold to any other independent party, but not to the related party. Okay, so government lots of times monitored this, like this kind of transfers, and they have an eye on the transfer pricing, and they ensures that transfer pricing actually reflects the arm's length. Okay, so meaning that the pricing should be similar to what unrelated part companies would charge under similar circumstances. So any questions on this so far?
No,
Okay.
as of now, no.
Yes, Munmun. Hello.
Yeah. Yeah. Go ahead.
Yes. So this transfer pricing, right? So the company must submit like extensive documentation to prove their like transfer pricing policies, right? Which will be complying with that arm's length principle.
Correct. So basically, there should be contract prevailing, like how they are actually calculating their transfer pricing. There are various ways of calculating transfer pricing. Like one being, like comparing the pricing which they will give to an independent party, then comparing the gross margin which they would have sold to an independent party and got that margin. So there are various, like models of calculating this transfer pricing. I'm not going deep into it. But whatever contract, like whatever model they accept, or in the contract, that should be like prevailing, like that should be like helping the bank to calculate their transfer pricing.
Okay. So each country has some specific regulations in this, right?
Correct.
Okay. Hmm.
Got it. So basically, say if I am selling any of the goods or services to my related party in some other country, then it is managed in this way that if the government has doubt, it can actually check that what policy they are using on the contract pricing. They can actually check that, like calculate the transfer pricing accordingly. Like, but if they would have sold that good and service to an independent party, not the related party, in the same similar circumstance, then what would be their pricing? If that comes same, then that is kind of, it should reflect the arm's length. So that is like reflecting the arm's length.
Okay. Thank you.
Okay, so let's go ahead. Okay, now what is the difference between related parties and interrelated parties? So there are two terms basically. So now let's see, like interrelated parties is mostly, like the superset, and the related parties is subset, right? Let's see by the definition. So we have seen like what is the definition, like who are the related parties. We know these things now by now. Now, transaction must comply with legal requirements such as arm's length pricing and the regulatory reporting. So this one also we have seen now, just now, like how the transfer pricing is, like strategized basically. But what is interrelated parties? So basically a broader concept that includes companies connected through corporate ownership, example, parents and subsidiaries, but does not necessarily fall under the strict legal criteria of related parties. So basically, interrelated parties may be related parties, like some transactions may fall under that legal criteria, but some transactions may not be the part of the related parties transaction. Like transactions may be the part of normal business operations within a corporate group. Example, inventory transfer between subsidiaries. So this doesn't fall under the related parties law, basically the compliance. So in broader concept, so interrelated parties is a broader term, wherein it is a like related parties a subset of the interrelated parties transaction. Clear? Okay. So now the interesting part comes, like why actually like we are talking about ICR and what is related party transaction. So let's see some scams, and actually like many of us know this has happened, but we don't know like why it has happened, how it has happened. So let's just like decode these scams. Okay, now anybody knows this gentleman? Okay, so this is a founder of Satyam. I think everyone heard about Satyam Computer Services. Ramalinga Raju. Okay, what is a scam type? Round tripling of the funds. Now, what is this? So, what has actually happened? In the infamous Satyam scandal, the founder, Ramalinga Raju, inflated the company's revenue and profits by manipulating intercompany transactions. Satyam's subsidiaries were used to create fake invoices and engage in non-existent intercompany transaction, thereby round tripling funds. What has happened actually is, like I have given an example here, say Satyam would show money being loaned from a subsidiary to another group entity, which would then come back as revenue. So one of the subsidiary of Satyam would lend money to another, like a unrelated party, basically a group entity. The group entity will again fund that money back to Satyam, and which they will show in their book of accounts as revenue. This created the illusion of increased financial strength and performance. When the scam was uncovered in 2009, the company admitted to falsifying over 7,000 crore, that is almost $1.5 billion in profits over several years. So this is a scam which has happened due to manipulation of the intercompany transactions. Okay, so let's see some more. Okay, so another scams are like infrastructure leasing and financial services. So this company, again, overstating intercompany loans and receivables. In ILFS fraud, the company misinterpreted its financial position by overstating the receivables and underreporting the liabilities. Means they haven't done the reconciliation. Whatever suits them, what condition suits them, they have made their book of accounts accordingly amongst its subsidiaries. ILFS had a complex web of over 250 subsidiaries, and intercompany reconciliation was a nightmare. Through its complex structure, the company kept moving loans between group entities and manipulated accounts to hide defaults and bad loans. The scam, which surfaced in 2018, amounted to over 94,000 rupees crore, which amounts to around $13 billion and is one of the largest financial scam in India. Okay, so again, a ICA scam. Let's see more. I think everyone knows this person. Okay.
Yeah.
So another scam. Kingfisher Airlines, fake invoices and ghost transactions. Kingfisher Airlines, owned by Vijay Mallya, engaged in generating fake invoices and booking non-existent transactions between its parent company, United Breweries, and other related companies. These fake transactions were used to justify siphoning of funds for personal use and misreporting the airline's financial status. Intercompany transactions were manipulated to give the appearance of a better financial position than reality. The company eventually collapsed under 9,000 crore rupees, which is around $1.2 billion in debt. So just imagine. So these are also very known gentlemen, right? Nirav Modi and Mehul Choksi, PNB scam. The scam type is ghost transaction and manipulation of forex gain. Again, an ICR scam basically. In the Punjab National Bank, Nirav Modi and Mehul Choksi used fraudulent letters of undertaking between their group companies to obtain loans from international branches of Indian banks. The fraud involved transaction between shell companies using fake LOUs as collateral for bank loans, which were never repaid. These intercompany transactions were not properly reconciled, leading to a 13,000 crore rupees, approximately $1.7 billion scam. By shifting funds between the related companies, they made it difficult to trace the flow of money. Okay, so this is another scam. Okay, DHFL, which is recently shut down. Okay, deliberate delay in intercompany settlements. DHFL was involved in delaying intercompany transactions between its parent company and multiple shell companies it controlled. These fake subsidiaries were used to divert loans and funds from legitimate investors, lending to non-payment and eventual default. DHFL owed over 90,000 crore rupees, which is approximately $11 million, to banks and investors when the scam came to light. The group delayed reconciling its intercompany transactions, creating gaps in its financial reporting. Okay. So this is a serious issue. Basically, this is a serious, very, very serious process. Now, some case studies we can see globally. So one of these companies is Enron. It is basically the US energy company. So again, the scam type is overstating asset and hiding debt through subsidiaries. Enron, a major US company, used its complex network of subsidiaries to hide billions of dollars in debt off its balance sheet. The company created numerous special purpose entities, which were technically independent but controlled by Enron. Enron would transfer debt from one parent company to an SP, like LJM or Chuco, which wouldn't be consolidated in Enron's financials. This made Enron look more profitable than it was, while hiding losses and bad assets in these off-balance sheet entities. When the scam was uncovered in 2001, Enron filed for bankruptcy, leading to losses of $74 billion for shareholders. Okay. So all these companies, you can see Parmalat of Italy, fake intercompany loans and receivables, Europe's largest corporate frauds, amounting to 14 billion in fake accounts. Lehman Brothers, very famous company, scam type, delayed settlement and misreporting through subsidiaries. The firm used an accounting trick called Repo 105 which involves selling assets to subsidiaries to temporarily reduce the company's debt levels just before the financial reporting periods. Another company, Wirecard, this is a German company, hosts transactions and overstating receivables. In the Wirecard scandal, the company used shell companies and fake transactions to inflate its revenues. The companies falsely reported that $1.9 billion in cash was held in accounts of subsidiaries in the Philippines which didn't exist. So these are all the scams of ICR process. Now, how the use of technology could have done better. So majorly the problems we have seen in ICR is fake transactions, misreported or hidden debts. So like company has fully, like kind of what to say that they have actually not reported that their balance sheet properly. It is an overstatement or understatement always. Manipulation of the financials, right? Now, how ICR helps ICR helps banks. Now, how banks regulates this basically. Now how it actually, like looks into the ICR to see the financial health of the company. Banks can better evaluate a company's financial health by verifying the integrity of intercompany transactions. How? Because if a company has a clean intercompany reconciliation, bank can trust that it manages its funds transparently, allowing a easier loan approvals. So basically, I told you that there are some regulations and banks always see that whether transfer pricing is proper, like it is actually par with the arm's length. Then kind of, like whether the interrelated parties transactions have done properly, like whether they have been, like compliant to the laws and also the company's acts and all. And also whether there is understatement or, like the overstatement of the assets or liabilities in the balance sheet. So all these actually banks looks into. So that is kind of ICR helps them to actually understand the financial health of a company. So if the ICR process a company follows is good, then like it is kind of, like the bank will be in a very like trusted mode that they can trust the company basically to approve the loans and everything. Okay. So now what could have been done better? Okay. So how we can use technology basically to like to have a like a different situation altogether. So blockchain can provide a real-time, transparent, and tamper-proof records of intercompany transactions. This we all know. Like blockchain provides a immutable ledger where you cannot modify anything. So basically, everything is tracked in blockchain. How it could have stopped these scams? Say for Satyam, blockchain would have verified every transaction, making it impossible to fake invoices. So if blockchain, like if it is on a platform of blockchain, this kind of transactions like fake invoices and fake transactions would have like come to picture altogether. Enron, the transparency of blockchain would have exposed hidden debt at every moment would be visible, as every movement would be visible. Sorry. So basically, any changes happening over there, like how the debt is moving and all between the subsidiaries, everything will be very much, like traceable in the blockchain over the blockchain network. So, any questions on this? Because I am almost, like ending this topic. Okay, so I just gave the overview of like how ICR works and what is the concept of ICR, why it is so important that like to follow certain rules and regulations in ICR, and also kind of how technology could have done better if it would have been implemented in that time, and kind of like we wouldn't have seen these much scams. Okay, so that is also one of the things. Now in the following session, like in the next session, we will discuss like how to do like analytics on some of the like ICR data to do a better decision making, and how it would help the companies like to take a better decision, or even the bank, and like who could like measure some financial health out of those data. Okay, so completing this, so I think Team Shihan has built a blockchain based ICR platform. So just stating over here, like Vinyog is a smart intercompany solution, which is a platform based on blockchain. And if anyone is interested, like to use this or to know further on this solution, I think I am just putting some of the links. So everyone can follow there, go there and contact, like on the emails or the phone number given. So let me just put down the links over here. Okay, so if anyone wants to connect to me in LinkedIn, just my LinkedIn account is given in the link. Also, like if anyone wants to connect to Team Shihan, so these are some of the contacts which you can follow. Okay, so I think this is a very overview I have given on the process. So in the next session, we can see some, like real data analytics on this ICR data. Yeah.
Yeah, myself, Sachin.
Yeah, Sachin.
Yeah, I want to know if AI can help to reduce these type of fraud transactions, like by pattern matching and other things. We can do that.
Yeah, so basically, like AI can, like based on the historical data, basically AI can do some anomalies, like it can track some anomalies, like some,
Yeah.
like if any dispute has happened, AI can recommend that this is something which is, like very much unprecedented. This should not have happened. Like, please check this transaction. But AI cannot stop anybody tampering or, like tampering the data and, like hiding any fact or any transaction. So that AI cannot do. AI can actually, like whatever data is fed to AI can actually seeing those historical parameters and historical feed. It can take a decision and it can actually recommend and bring some recommendation that this is not correct. This is overhyped. This amount is showing which is overhyped. So this kind of a recommendation it can do.
Okay, based on the historical data, it can only predict. Am I
Correct.
saying? Okay.
Correct.
Okay, but by the help of blockchain, we can take the transparency. Am I right?
Right. So basically, on blockchain, we can actually get the transparency. If any transaction once recorded, like all the movements will be tracked. Like you cannot hide anything basically over there. So blockchain gives you that. AI will, like we can blend blockchain with AI. If the platform is altogether in blockchain, then it will be giving a immutable ledger and everything. AI can help on top of that, getting those data. Like if a model is built on top of that, it can actually recommend you the, like the disputes and all. So it can actually give you better predictive maintenance kind of like before something is happening, it can just recommend you that this amount is looking a little bit overhyped. Please look into it. But again, it's a kind of a manual intervention. A person has to look into it.
Okay, thank you. And last question is that how can we go into that field, like where these type of interesting things supposed to be happening? Because currently I'm working as a developer,
Mm-hmm.
and in future, how can I?
Like you want to work in intercompany reconciliation, like you want to move your career to finance, or like you want to develop something on this platform, like or
No,
analyze some data on the platform,
I want to develop like that.
like on blockchain.
Yeah, like blockchain or by using artificial intelligence, like historical data.
Yeah, so basically, like if you have the proper set of historical data, probably I will bring some data, like create some data like in the next session and try to show some analytics, real analytics.
Okay.
But if you are like having that data, you can actually, like I think the next session will help you to understand that how I am doing it. Then probably you can also, like take the same data set and practice. But for blockchain, you can always learn blockchain. Blockchain is a, like a very interesting field. You
Yeah.
can actually, like try with Hyperledger because that is a permission blockchain. You can start your career and then you can blockchain is a since it is very vast. So don't go only with the cryptocurrencies and Ethereum, all those things. But yeah, start with like building some real applications with blockchain.
Okay. Actually, in my graduation, in the BTech graduation, I learned about cryptography and about things, but not much about blockchain. That's why. Okay, but I try to learn.
Yeah, like there are certain courses available. Actually, like in blockchain, the experts are very less. So
Yeah.
probably you won't get very authentic tutorials or videos in blockchain. Try to like go to some institutes and try to learn on Hyperledger and how blockchain network actually works. It is basically a API based system, so it is not that much like that much. It won't be difficult to learn. But since like very less people are available, so we actually like think that like it is kind of something which is we cannot achieve.
Okay, thank you.
Any other questions, guys?
No, Munmun.
Okay, so let's close this call then. Okay, thanks everyone. See you all next week.
Thank you. Thank you.
Thank you.